Hey y'all, welcome back. I can say y'all because I have a fellow Texan on today. Kevin Peranio is joining us from PRMG. He is the Chief Lending Officer over there. We are talking all things public companies, earnings reports, what all of that actually means, what all of the information from Q2 indicates for our channel moving forward. Kevin, thank you so much for joining me from Texas.
Yes, from Fort Worth. I haven't been here in a long time. Thank you for having me. I appreciate it. One Texan to another here.
Exactly.
I'm honored to be on the show with you, so thank you.
We got to coordinate this better next time so I can actually be in Texas with you, because we're in Philly, you're in Texas instead of California. Next time we'll meet up at the Texas OU game and we'll do a live from there.
Oh yes, I'm in on that. Trust me. You know, I don't miss that game.
Ever. Well, we're going to jump right in because we know you've got a lot going on. We saw a lot of lenders go public this year, which is something that our industry, specifically lenders that operate within our channel, haven't really done. What does that mean? Why are they going public this year? What was the driving force behind that? And what are things that we should be looking out for now that there are so many large lenders that are not operating completely privately anymore?
So I love this whole topic, and I just want to kind of set the table. Why I was so excited to even talk about it. I pay a stupid amount of money for like stock subscription news. I pay for analysts. I mean, I could name a bazillion of them. You know, every single service for Motley Fool, every service for Oxford Club, Investor Place, Platinum Growth Club, every single Stansberry Research, Ivy Zellman for housing analysis, and the data that goes into researching stocks, it's insane.
Yeah.
And I'm not an analyst. I'm not smart enough to go in, and I don't want to listen on earnings calls and listen for little nuggets, but I like getting the reports and the clip notes from the really smart people that do that. So for what it's worth, in being a C-level executive and an owner within the mortgage banking industry of an independent mortgage bank, that's, I guess, I don't want to say that's my qualification for talking about this, but at least you know where I'm coming from.
Yes.
So there are much smarter people than me. But you know, I think every company goes public to pull a lever on liquidity.
Yep.
And you know, if you really base down what we do in our business, and this is not the American dream, the fun part about, you know, what the story is with our consumers and building our community. What we're looked at is we buy and sell money.
Yep.
Okay, so we buy and sell money. That's it. This mortgage-backed security is a safe asset. It is a fixed income asset, just about as good as a treasury. And it's seen as a safe haven, a quality investment. And it's backed by a house and a land as collateral. So we buy and sell money. And that money, that cash, is what's needed to run our businesses. And so, you know, the biggest buyer of mortgage-backed securities is the Fed, and they're pumping a lot of liquidity. And they are going to stop buying as much mortgage-backed securities as they are now. They say they're buying 40 billion a month. They're really buying like 80 billion a month. And they're already talking about tapering, as we just saw with Jackson Hole meeting. So when there's less money in the system and less buyers of mortgage-backed securities, margin compression will happen. And so it's just simple supply and demand. There's less buyers of that money. And that means the people that are left buying, they're going to demand more yield, more return. And that's what compresses the margin down. So a lot of these companies, they went public to raise capital. And they have built these fantastically run businesses with incredible leadership teams. We know many of them personally. And they're running at a high level. And so they're going to just tap the public market, okay, people who buy stock, for liquidity so they could set it aside. Now, there's different levels of that. You know, when people say, you know, this company's public, well, they're not 100% public, right? And so there's kind of this thought like, well, now that this company's public, they have to cater to shareholders. They have to cater to the analysts. Well, if only 7 or 9% of their company is public, they're catering to anybody. They just wanted to pull a lever to get some cash, you know. So, you know, so we know these leaders, and you know, we can say by name. some of them we know aren't going to cater to anybody. They're going to run their business how they want, right?
Very true.
So, but to pull that lever, and to have that liquidity and have it sitting there is a real safety net for a business that's all built on liquidity, especially with the coming margin compression that's already started. I mean, it's already started, and it's going to continue to get there. And that's just a function of the market. So that's why a lot of companies do that. Some of them, they want to pay out early investors and shareholders. I understand, like Guild, for example, they wanted to pay off some early partners that just take some chips off the table. I think the same thing went with Home Point. There are people that build these businesses and put money in along the way, and they're given shares in these companies. And going public is a way to cash out. It's a way to just let's take some chips off the table, paid for by the public who buys our shares in our publicly traded stock.
Got it. So what is that with the number of companies that are in that space, all at varying levels of, we'll call it publicness, right? Anything from 6% to 60%. If you're looking at the lenders in our space, what does that mean for the future of our industry? Are we putting ourselves at risk? Are we giving our industry opportunity for additional investment? Is it added scrutiny now that you've got all of these analysts that are really looking at what's happening in the mortgage space? What does that mean for the rest of us?
Well, here's the reality: is Wall Street looks at our industry as basically we rise and fall at the whims of the Fed, and that's the real deal. So we're coming off a record refinance boom. We did over $4 trillion in loans last year. We're going to do, not quite that much this year. Certainly, over 3. I've seen some people say 3.9 trillion. Just kind of depends what happens here in Q4. But the reality is the way that institutional traders look at our stocks is they say, well, they're only as good as the Fed allows them to be. Now, what's interesting is there are several companies that have gone public recently that are category defining companies and really lean into their technology and lean into their niches. And so everyone has a different story to tell to the public market. So now that these companies are public, you see them on their earnings calls. You see them on CNBC. You see them on Cheddar. You see them on Bloomberg. And they're telling the story of why they're different and why they're not just at the whims of the Fed. And so I can give you an example. So Finance of America, Patty Cook, she goes out there, she talks, dynamic, powerful leader. And what she likes to say to differentiate her company is that, well, we're not just a mortgage banker. We also have these other ancillary lines of business, like we do title and we do appraisals and, we do cap market services. And so they like to say they're the suite of services. And so, do institutional traders believe it? Do they buy it? Do they buy the stock? Time will tell. And that's, and at the end of the day, the thing that matters more than anything, where it all just comes down to it, is earnings. And so when you're a public company, one of the decisions you've made is to be regulated by the SEC. And the Securities Exchange Commission is really a disclosure regime. And so all they want companies to do is to disclose their business and disclose the truth and disclose things that they're doing publicly, because now they are publicly traded and they are there to protect the public. If I'm going to buy a stock in one of these companies, the SEC says this company needs to be truthful about what they do. Are they hiding losses? You see these companies in China, like Luckin Coffee, they were cooking their books and that stock, went like almost to zero. Just say, like, full disclosure, like I trade stocks a lot. Like I'm into it. Like I love this stuff. And so, the SEC wants to make sure that these companies are disclosing what they do and they're truthful about it. And so at the end of the day, earnings is what matters, right? And so there's this one ratio that's called a PE ratio, the price to earnings ratio. And that's kind of one of these numbers that just kind of dumbs it all down. All right, what's the price of this stock versus the earnings of this company, and what is it trading at? The S&P historically trades around a 25 PE. Lenders in our business don't trade that high. Tech companies like Amazon or Apple, they'll trade at even higher PE multiples. Mortgage stocks, unfortunately, fair or not, they are not treated by institutional investors and traded at this high PE multiples. They just aren't. And again, because they think that if rates are good, we're going to make a lot of money doing refis. And if they're not, well, then we're not going to make as much money because we're not doing as much volume. And it's as simple as that. Time will tell which companies are gaining market share as the pie is shrinking. Just holding on to your share is a good feat. That doesn't mean your earnings are good. Okay,
Yep.
so market share isn't good enough for institutional traders who, the stock market is rigged. Okay, so let me just make this point. And I'm not a conspiracy theorist.
Okay.
It's flat out rigged. So did you know? So family fund offices and hedge funds, anyone that has over $100 million in assets, they file what's called a 13F form. It's a public form. Okay, so if you control that much asset as an individual or a family fund office or a hedge fund, you must disclose what you buy and sell. And those funds, if they want to go buy a couple million shares of Apple, they don't just pull up their Interactive Broker account like I do and go to, buy a few million shares of Apple. They would, move the price of Apple stock. Although Apple's kind of hard to move because it's a $2 trillion, $2.3 trillion largest company in the world. But smaller companies, like in our mortgage business, they would crater these prices up and down either way. These institutional traders, they have separate exchanges. They're called dark pools, okay? And they trade in these separate funds that we don't get to trade in. The regular public, the regular retail investor, they're trading overnight in different exchanges, and they kind of bleed their way into the Asian markets. And then when you wake up in the morning, you ever wonder why, hey, the earnings report was really good for Rocket in Q3. My options trade, I'm going to make $14,000. And then I wake up at 6:30 a.m. and the second the market opens, it's down $7,000. I lost 21 grand swing before the market even opened. Why is that? It's because the institutional traders, they saw and recognized that news that Rocket had a fantastic Q3 at the end of 2020, but they know that that's it because that's the peak of the refi boom. So they sold it all. And so it is a rigged game. And I'm telling you, it's really hard to trade these stocks. And so I think what's going to have to happen is some of these category leading companies are going to have to prove to institutional investors and analysts who really move the needle on stock prices that they're more than just at the whims of the Fed. They're going to grow their earnings quarter after quarter, and that price will be reflected as such.
So taking it back just a little bit, if we're looking at the earnings report from the perspective of not a trader, right? So not you, because you're looking at it with interest in the stock market in general, but for a broker, for somebody in our channel that's saying, all right, I'm looking at an earnings report. It says that things went well in the last quarter, but what does that mean for me? What is the impact to a broker? What is the impact to the lender that's public and the channel itself? Because outside of actually swapping stocks and trading or investing personally, there's still an impact to the ability to do business or who you want to work with and your day-to-day exchange of being a broker. But what should you be looking for in an earnings report? What does that actually mean for us?
Well, I think for brokers, you can see some strategy. So some lenders reported heavy losses in Q2, and I think part of that is them marking their servicing portfolio to the market. And so lenders that have really heavy servicing MSRs, mortgage service rights, they mark when interest rates come down, the value of existing portfolios also comes down.
Right.
And so you see these huge headlines like, so-and-so lender, had a, multi-million-dollar loss. And then, so you want to read the fine print and go, at first you're like, okay, well, is this company, is it poorly run? Are they doing a bad job? What does that mean for me? I mean, my AE tells me everything's good and things seem to be going good when I use this lender, but then I'm reading this headline in this article that they lost this money. Some of it is, simply just a function of the timing of the market. Some of these lenders wanted to mark down their portfolio in Q2, but you know what? If rates go up, then the values of those portfolios, they go back up again. And so I think it's different depending on who your partnership is with as a broker. When you read these headlines, at the end of the day, does anything really change in the way they're operating? I mean, did their turn times Did they stop funding loans? Did they stop buying your loans off the warehouse line? Are they having money problems? Did their turn times go to 3 months because they're cutting costs and staff? I mean, that's kind of how it makes its way into how we operate every day doing loans. And so unless you see signs like that, it's mostly just headline numbers that, it's just a quarter by quarter playbook, and it really wouldn't impact the way you see and operate with your lender partner.
So on that, there are a lot of numbers that get thrown into these earnings reports, right? And if you actually listen to the earnings calls themselves, there's a lot of what I'll call marketing that goes into the actual earnings call, right? Things the spin that makes it, you got to tell the right story and make sure people are walking away with the message that you want them to retain. Any advice on what we can be watching for, or things that we can listen to say, oh, okay, I see a big number, I see a headline, I see a flashy story, but what's really going on behind the scenes? Because we saw a couple of lenders that claimed at least static, if not growth in our channel, that I think was a little bit surprising to some people that are on the ground every single day. How do we peek through, or peek through, I guess, the numbers and the stories that are being told and actually get to the reality of what's going on?
Well, I think what you're looking for is consistency in the story. And so, does the spin or the story, does it change? And if it changes, is it changing for the better? It's tough. I mean, sometimes these public companies are going to have a bad quarter,
right?
And their volume is going to go down and their earnings is going to go down. And that leader, whoever it is, has got to get up on TV or in the earnings call and say, hey, we're facing tremendous headwinds because interest rates are going up, and there's a foreclosure crisis, or whatever the case may be. I mean, I don't predict that at all by any means, but I'm just saying as an example, in 08, in 09, I mean, that's what some of these earnings calls, these public companies were talking about. They're like, yeah, we face a liquidity crisis. We don't have enough money to keep growing or to even stay in business. So, I look for consistency in the story that they're telling. I look for, at the end of the day, you can kind of cut through all the spin and look at the numbers. So you can look at PE ratios, you can look at market cap, you can look at multiple, you can look at earnings. Do they have, just from a quantitative standpoint, one of my favorite investor analysts I listen to is a guy named Louis Navalier for Platinum Growth Club. He's unbelievably amazing. And he's funny because he talks about, he goes, I don't buy banks, like they call them financials, like the big money center banks, like Wells and Chase. He goes, I don't buy their stocks because I used to work for them and I used to window dress their earnings reports. So I know how they make things look better than they are. And he has a system. He looks for earnings growth. He looks for raising guidance on future sales. He looks for institutional investors putting money in these stocks. And he looks for consistent earnings upside surprises. And then, of course, he's looking for no bad news. So, some of it is just math, and so the story is the story, which is compelling. But at the end of the day, you have to listen to the consistency in that story. So we've been hearing some of these leaders that are now public, say why they do what they do, where they're taking their business, what their business is all about.
Yep.
Well, will that change? Will that story change? When you see these leaders get up and talk. And so I think that's kind of what you look for. And it's amazing. I mean, it's amazing. These leaders are getting out in front of the public, and they're consistently telling these stories about what their company and their culture and what their mission is. And I think it's just fascinating that they're doing it, and they're doing it on a consistent basis. And some of them are showing high level growth. I mean, it's unbelievable. Yeah. I mean, you see some of the growth. They're talking about their margin, how much, their gain on sale, what their basis points, what their purchase mix is. Are they increasing their purchase business at a high level? Where are they at year over year, quarter over quarter? It's amazing to see just the winning that's going on in our business right now.
Yeah, that's the number as a very uneducated compared to a lot of people who would be watching this, and definitely you, watcher of the stock market myself. It's that purchase percentage that tends to be the thing that's always really fascinating to me. Is it ticking up? And we look at the same thing for loan officers in our market, and who's actually doing is 100% of your business refi, and then what are you going to do next year? Same thing on the lending side, right? Where is the vast majority of their business coming from, especially in wholesale? Brokers are using you. What are they using you for? And is it a sustainable model going into the next 5 years? to really break it down to the basics, that tends to be the one trigger for me, at least, is that purchase percentage. It's a tongue twister. Is it going up quarter over quarter, right? Is refi to slow down? Is that continuing to increase?
Yeah, maybe the most pessimistic person would say, well, of course it's increasing because rates are going up. There's less refinances. But we all know, especially if you're an originator, those loans don't just walk themselves in the door. You have to go fight for them. And you have to build relationships within your community to get that business to come, to build that trust. And what I noticed is since May of this year, that I've seen in all three channels, I've seen originators really put that focus back on, getting more purchase business and make that transition. Some of these companies that are 90% refinance, it's not going to be easy for them to transition.
Right.
Companies that aren't deeply rooted in their local communities, it's going to be hard for them. And so that's where I love, the originator. That's who we serve at PRMG. That's our slogan. They're in the communities. They're the ones that have past client databases, have realtor connections. Purchase business can't always only be lead gen, although that's being perfected, better and better by many companies out there. And so it'll be interesting to see how people kind of sprinkle in some more consumer direct activities, even if you're a traditional originator within your community, and doing that with purchase business. And we're seeing a lot of that go on. There's a lot of technology out there and marketing automation and lead flow that's helping originators win that purchase business. So yeah, I look at that purchase business percentage. It's been coming up big time since May.
Yeah, absolutely. When you and I met for the first time, that was the very first conversation we had. It was the companies that are going to win are the ones that find the model in between consumer direct and wholesale, or consumer direct and the local originator. How do you create that hybrid that has people ingrained in their local communities, but also leverages automation in a way that doesn't replace the originator, but that helps supplement their expertise and allows them to focus on the things that you can't put into automation, but has the follow-up, has the consistent communication, all of those things that the big call centers do really well, right? But marrying that with somebody who is local and there on the ground, talking to their neighbors. You've always been a fan of the local, an advocate of the local originator, regardless of channel. And I think that's such a huge, important factor going into purchase season, or the heavier purchase model, because it is relevant. It's more important to know somebody who's down the street than it is somebody who's sitting in Michigan in a call center. When you're talking about buying a house, you're going to spend hundreds of thousands of dollars. Like, it's a big decision.
I agree. And, I'm not a fan of that model for purchase business. And, I used to always kind of like tongue in cheek say, what is a little white dude on a headset in Detroit? What's he going to say to my Spanish speaking, family down in, Miami-Dade,
Right.
And then, then the counter is like, well, they'll just find someone to speak Spanish. It's like, it's not the same,
Not the same. It's not, it's like culture.
Yeah. It's like, I want to be over here because, Sergio's is right down the street. And I got to get, cortadito, and I can, go get my Cuban espresso at the end of the day. I know where the good schools, no, that neighborhood, you don't want to go over there. You want to go over here. Yeah, you could maybe try and find that knowledge and put it in a knowledge base and try and automate it, but it's not the same. The local originator is where it's at. And I agree. If we continue to arm the local originator, create a path to pivot to more consumer-facing activities, yet keep that essence of them being in the community. That is the best option, I think, for a borrower. And so, yeah, I can't wait to see where this industry goes over the next 5 years, because it's just there's so much that's going to change, but then again, there's so much that's not. A first-time home buyer, they want their hand held. They want to talk to an expert. They want to talk to someone that knows what they're talking about. And you cannot recreate that. I don't care what Better Mortgage thinks they're going to do. They think all salespeople are evil because they make commission. Get out of here. They earn that because they've been building in that community together for years. And okay, so margin compression comes around and everyone's got to work for less. Well, then everyone will just work for less. You'll just have LOs doing 50 to 100 loans a month because companies like us are creating systems for them to do that. And so the cream will rise to the top. And that includes local originators that are in the community that know what they're doing at a high level. And I don't see that changing anytime soon. But I do always act as if there's an extinction event around the corner. So it keeps me motivated to keep, trying to run and serve for success and continue to be an advocate for those local originators.
Well, and to your point, those local communities, in my opinion, the thing that's going to change the most in our industry is less about the things that home buyers need and more about the people who are working with those home buyers. So when you're looking at local originators and bringing more people into our industry that outside of the LO that's aging out, who else is now coming in, right? And that I think you're going to start to see a big pivot or a shift in what a loan officer looks like or what an originator, who they are, where they've come from, what their background is, how they got into the mortgage space. The average LO, we talk about it a lot, is 50-something-year-old white guy that is doing great work right now, but they're going to retire in the next 10 years. Right? They're not going to be around. And there need to be more people who look like me. I tell the story all the time. I had a broker who was great, but he asked me 9 times during the process of buying my house if my dad was going to co-sign, because he did not understand how a 26-year-old woman could be buying a home on her own. And he was nice. It wasn't intended to be offensive. He just didn't get it, right? Because he didn't come from my background. He didn't understand what I was doing. And I think you're going to start to see, it's a big part of the reason why you guys are such big advocates of Spark and what we've been able to do in looking at bringing more women in, bringing more minorities into our space, bringing veterans in who can help communicate with their communities in a way that's different than somebody who hasn't actually been through those life experiences.
I agree. And I love the fact that you just kind of talked about the broad diversity within our industry. When I first started in the business in 2001, I worked for First Magnus. I was a wholesale account executive. And at some point I would fly in every month and train all the new account executives. And one of the things I talked about, and you just made me think about it, is I really push people to embrace their own communication style.
Yep.
So you may be, in an Asian community, Vietnamese, for example. I grew up in Garland, Texas. We had a huge Vietnamese community.
Yep.
And so embrace that and embrace your community, or maybe, like you said, you're a veteran, and you want to embrace that community. You look at Chris Griffith and all the stuff he's doing. And so you embrace your communication style because there's always an audience for it. The amount of consumers out there is broad. And so I love the fact that, Spark is giving a voice to people that might necessarily have a voice. You're helping, people get started in a business and just getting them that little push over that one hurdle that they might have. And so, at the end of the day, I tell every sales professional, just be yourself. Just don't be invisible. Just embrace your own communication style, because trust me, it'll resonate with somebody.
It all comes back to authenticity, right? If you talk to your audience the way that you would talk to yourself, people are going to believe what you have to say and it's going to resonate. We actually have a session on that at Fuse. So I have to ask you,
oh, cool.
Are you excited? We cannot wait to see you. PRMG's hosting a party again this year.
Yes.
What are you most pumped about?
Well, I love the community. And so I love the sense of community that was created. One thing about the broker channel is it's interesting is that you've got these entrepreneurs that run their own company.
Yeah.
But who do they look up to? If you're like, I'm not going to work for anybody, I'm only going to work for myself. I run my business. Okay. Who does that person look up to? They got to look up to somebody.
Yep.
And so what I like about AIME is that they've created, where that vacuum existed, they created a select group of leaders to kind of come in and just give ideas and share and collaborate with these entrepreneurs. And it's gotten to the point where it's created a community, and I like that. And so, we build culture at all of our companies. That's what we do. And I hate to use the word culture, because when you talk about culture, it's like, there it goes. You don't want to. I don't like using the word, but it's what you're doing. You're building a culture, and AIME has done a good job of that. There's a lot of great companies do a good job of that. We do that at PRMG. Our focus is the originator. So you talk about these companies that go public and they tell their story. I'm very keenly aware to say the word originator, because we want to serve all originators. We're like Switzerland. We're just like, let's just help anybody. We just want to help anybody. We're all, humble servants. That's our deal. But this show particularly is jam-packed, and I can't wait to see it. Growing the channel is a big deal. So, again, we're serving our communities. AIME Fuse is fantastic. I'm so glad it's not during Texas OU weekend.
So AIME Fuse in 2019 was during rivalry week, and it was so tough in that exhibit hall because we had all of those TVs where people were trying to watch games. You know, as a football fan, I could never align our event ever again with something that big. We just can't do it. I won't miss those games myself. So very cognizant of that now when we're planning our event dates.
So I was a freshman at UT in 1994, and I only did 4 years of college. Since 1994, I've missed only 3 Texas OU games. No matter where I live, I always fly back to Dallas. And that AIME Fuse show was one that I missed because I was like, God, did y'all really have to do it on this day?
Yep.
And I actually, what's funny is OU just kicked our butt that week. So I was kind of like, okay, if there's one to miss for this show, okay, at least we got our butts kicked, and I wasn't walking away pissed off out of the Cotton Bowl. But yeah, so thank you for not aligning with that week.
Yeah, absolutely. Anything for you, KP. Anything for you. Well, if you have not registered yet, get your ticket to Fuse. PRMG and the whole team over there is hosting an after party on Saturday night at Lily Lounge. It's one of everyone's favorite events throughout all of Fuse. We've got a WMN summit. It'll be our largest women's event ever. We'll have about 450 women there, which is wild. Women only for our summit on Thursday that'll walk through all kinds of topics that are relevant in our space, from being an entrepreneur to work-life balance to imposter syndrome and all these other things together. We've got leadership happy hours. We have exhibit hall happy hours. We have kickoff parties, after parties, the whole thing, not to mention Molly Bloom, Magic Johnson, Simon Sinek. It is a stacked agenda, and KP, I am so excited to see you there. I haven't seen you in way too long in person, so it will be so fun to finally get everyone back together.
Yeah, I'm excited. You've been hiding out in Philly, but you know what?
I know.
Let's round up in Vegas.
Exactly. That's exactly what we're going to do. Boots and all.
Yes, I'm in. I got them on right now, of course. Perfect. Let's go.
I'm not going to show you, but I'm also wearing mine right now. Thank you so much for joining us. This was super helpful. We'll bring you back after Q3 earnings reports and figure out what they tell us and what that means going into 2022 and how that's going to impact the market next year.
Yeah, let's do it. It'd be awesome. I really appreciate it. Thank you, Katie.
Awesome. Well, thank you again, everybody else. Again, if you haven't gotten your ticket to Fuse, we'll drop the link somewhere in the comments here. Go ahead and snag that. It's going to be an awesome time. You come hang out. Kevin, Katie, it's going to be great. Bunch of Texas folks that'll be out there ready to show you a good time at Fuse. Have a good one, y'all.
All right. Thank you.